Good evening. This is Ken Long at Tortoise Capital with a review of the weekend trading report for March 25th, 2017. What I want to do this week is go a little slower and walk through this checklist, the market report review routine. This is the sequence that I go through each week and the parts of the reports that I'm working on. There's three clusters. The first section really is dealing with the condition of the market and some of the broad tendencies and posture and structure. In the middle section, this is where I'm looking at a combination of sectors and swing trade candidates and daily targets through a variety of lenses like channeling and overreaction and swing patterns and so forth. And then I review pretty briefly what I would call intraday insights or one-day market condition checks that help set me up for my preparation for the next trading day. And so basically markets, leading candidates, I'm looking for different angles on and insights into what the market's doing, and then some actionable signals. I'm looking for confirmations and logical connections in here. And then things that will help me be ready for the next day based on more detailed insights into market conditions. So let's start off with the markets. Market classification. Long term, we're in bullish normal conditions based on our market classification system. I look at then I'm looking at the annual market condition with RSI 14, weekly RSI 14. We're at the higher end of neutral at 67 out of 100. And then the short-term market condition using 10-day NDX, we are slightly oversold at 17 out of 100. So that's the first two parts here, the long-term and short-term. Then some additional short-term indicators here in the market mosaic. I look at price with respect to the 200-day moving average right now is white bullish, meaning that it's above the 200-day moving average, and considering all the statistics of the last 180 days, this is above average but not exceptionally so, and that's why it's white. If it were to be green bullish, this would be abnormally strong on that reading. Slope of the 50 is yellow neutral at 0.35. ADX is a strong upward trend at 29.2, although that has been declining lately, as we'll see a little bit later. I now am going to look at the risk Z, which is the 30-period moving average of the VIX divided by the 10-period. The boundary between risk on and risk off is 1.0. The current reading is at 0.971, so we are in risk off. Holding riskier assets is not favored. Starting new swing positions is not favored on the long side. We then take the Z-score of that risk index, the 0.971, compared to the last 5,000 trading days to find the average, the standard deviation, then compute the Z-score as minus 0.42. And we look at a 90-day histogram of that indicator. You can see here that we are in the red, below zero. We tried to break above, but didn't. Now we're still at this, still normal-ish, and there is a strong potential for a sharp downward move when it looks like it. Now, when that histogram is in the red and declining, that's a riskier moment to engage in long-term swing positions, and warns us to be ready for short-term volatility spikes. That's why VXX is such an extraordinarily good symbol to be focusing on right now, and its partner XIV. So let's take a look just at Friday so we can see why that is the case. So we're looking at 3-minute charts on XIV right now. Just notice from 12 to 3:30, to 4, excuse me, we had a move from 70 to 66, and then back to 69. That's two 5% moves in 3 hours of trading. So you get some of these very sensitive, volatile symbols make for lucrative potential for intraday trading. So that's why they're on our short list right now. All right, so next up we're going to now consider some relative strength leaders in the form of the blended monthly rebalancing. So we're looking at the current holdings with a reevaluation due on or about 1 April. And so that's going to be later this week. And then the current leaders in the clubhouse as of Friday's prices are these for the ETF 13, 22, and 32. So it's Latin America, emerging markets, Australia, mostly. There's Brazil, and there's more emerging markets. And then in the among the stocks and ETF max areas, you can see the leading candidates. Theoretical exposure of the ETF2 models at 90%, the model portfolios at 100%. So from these two, the RS leaders, ETF2 allocation model, I'm looking for broad global leadership. Next, we're going to look at some blended monthly rebalancing insights through some different portfolios. And so in the ETF 13, notice everything's on a buy signal except for U.S. small caps. We know right now small caps are lagging the rest of the global markets. Latin America, emerging markets, Australia, Asia, less Japan. The first U.S. ETF in the Qs. In ETF 32, similar patterns. Again, Brazil, Latin America, emerging markets, Australia. At the bottom, energy, commodities, agriculture, treasuries. And again, you can see how low U.S. Small caps, the Russell 2000 are. Even XLF, which had been a leader following Trump's election, has moved into cash and is now lagging. ETF Max, similar conditions here. Although one thing I like to look for on this is when you have extraordinary blended long-term performance and then short-term sharp pains, those are either symbols that are ready to rebound after this sharp sell-off, or where that long-term relative strength is cracked and these are going to have some more negative follow-throughs. So this is putting a little cautiousness here on Brazil. So in some of the longer-term smooth measures, they're doing excellent. Just notice that there is potential for sharp short-term retention. So relative strength works until it doesn't work. Then shift into the S&P 500. Again, some things like Micron, Western Digital, Tiffany, Adobe. These are things that are all greens across the board, and they're not only strong on 3 months and 6 months, but the 1 month and the 1 week performance are also exceptional. So if it's exceptional compared to its peer group, it's going to be in green. Otherwise, white is above average, yellow is below average, red is exceptionally below average in its peer group. So we can use this as a rough sorting mechanism for relative strength, and that's what I'm looking for on these BMR insights. I'm looking for extreme conditions. Next up, I look at market health check, which is this 90-day look at the S&P. I see that the river is sloping up. The dragon had left the river, and it's hard to maintain that kind of upward slope, and so this sideways grind has sort of brought the dragon back into the river. In fact, the baby dragon has already passed through and rolling down. Slope of the 10-period regression line is down. The 30 is still up, and so that's longer term favorable. These vertical blue lines are 10, 20, and 30, 40, 50, 60 days of look back, just to get a sizing by that 10-day chunk, if you will. This sine wave is the slope statistic of the 30-period regression line. And this is where it peaked here and here. The fact that the peak was lower gives me some indication that the strength of that move was less than the previous one. And then even though on the bottom of that slope here, it's still at 0.09, it's still above zero. So it's still positive, but it's just not nearly as steep as it was. And now we're back down in this kind of territory again. This is where, if this sine wave of upward strength were to continue, we'd expect to start seeing some upward moves now. I'd be surprised if that's the case, but I've been surprised before. We've had almost 30 days of nothing, but then there were 30 days of nothing, mostly sideways here, and then we got that strong move. So that possibility's in there. Maybe this is just building the base north of 293. 233, excuse me. You see the 200-day moving average just crept in. These horizontal red lines are places where support has been made in the past, and where if we get support again, I'm not surprised. All right, so now we're going to look at the world market model. I look at the indices here. First, 9 out of 10 are on buy signals, so we're at 90 and 10 in terms of allocation. The EFA, the global, at 67 is better than the U.S. at 64. So I'm looking globally now for opportunities. Inside the U.S., 4 indexes, it's the tech at 71, S&P at 64, then mid caps, then small caps. The 2 strongest sectors are emerging markets in Latin America. The 2 weakest sectors are the U.S. mids and smalls. Inside the sector spiders, energy lagging, and now financials have come out of the green into the white. The rest of the U.S. still above average, though. Expanding this to look at the world market model now. So here we are at world market model. I'm seeing only the large caps and mid cap growth are above average for the U.S. Mids and smalls are weak. We just saw evidence of that elsewhere. All of Asia above average, and lots of it well above average. Asia less Japan doing very well. Latin America, emerging markets, Mexico and Brazil. It looks like the markets have been caught up to the Trump hype, if you will. The weakness in energy is global, and the strength in technology is relatively a global phenomenon. Notice oils and commodities weak. Silver and gold now above average, along with private equity. Now looking at the ETF2 model, for among the top 30 ETFs out of the 900 or so that are in the database. And all of these that are green and strength and consistency are longer term relative strength leaders. The things that are green and white are ones that have recently moved to the top. So this is really representing a changing of the guard, led by India, Latin America, South Korea, Spain. And you can see the global is really starting to take over. Same logic looking at the Dow 30 from the ETF2 model. Apple and Boeing remain at the top. Still long-term strength in American Express, DuPont, Disney. But these 3 here recently moving up to the top because they are green and white. Visa, Home Depot, Cisco. At the bottom, only Exxon, truly in the red and the red. These that are red and yellow in terms of strength and consistency are recent bottom dwellers. Chevron, GE, Intel, and Verizon. ETF liquidity, these just a review of the most liquid and most volatile ETFs to give me some idea of tradability for intraday trades. So things like gold miners, the VIX, Brazil, oil and gas exploration, regional banks are on that short list. Shifting to the daily now, really has a lot of similar symbols we've already seen, so I usually go right to the ADX, and you can see that strength of trend is diminishing. The bulls have now cut back under the bears, so it's really more of a longer term weakening in the U.S. In terms of trendability. The S&P is on a channeling signal. So now I'm getting ready to look through a new section. I'm looking now for specific targets on for among the sectors, among swing candidates and day candidates, reviewing this next set of reports for ideas. The channeling and overreaction, only the S&P. Min and max pain highlights, I really just look at the maximum pains. These are the ones that have lost the most over the last 10 days. And there's some symbols in here that we recognize. And then a swing summary, where I'm looking at plenty of auto framers and 551 candidates, and plenty of ETF symbols among the different swing patterns. I'm not going to dwell on those right now. We have a separate workshop on that. I then am looking at the ETF and the Dow the Dow and the ETF 30 tactical summaries. And here's where I'm looking for what patterns have fired from among the swing trades. I'm looking at max pain range compression priorities and the auto framer reward to risk ratios. In this column under fraud quality numbers are anything better than 3 leaps out at me. In the RSI2, things that are firing green are ones that had exceptionally strong sell-offs over the last 2 days. In the price change percentages, the ones in red are have sold off a lot compared to their peer group, in this case among the Dow, over these various time frames. The ones that are in the green are exceptionally strong compared to their peer group. So looking at Apple, although no swing patterns, it just has been dominant in every single time frame. So in terms of relative strength leader, that's certainly one to look at. So from this summary of signals and some of these performance data, this is where I am building my my daily price tables and definitions from among the various statistics like range stats and gap stats and so forth. So this is my integrated tactical look as I'm looking for candidates for tomorrow's trade, and along with some swing trade candidates as well. Same thing with ETF 30. I'm noticing that oil and Brazil and XIV were big one-day losers. I like oil and Brazil because they're firing high on the max pain range compression. The auto framer is sort of the one-day automatic trade frame, and then converts that into a reward to risk ratio each and every day. So anything better than 3, or better than 2, excuse me, is highlighted on this one for me, and ranked by reward to risk ratio. So things like Goldman, Financials, and Morgan. These are ones that have sold off from their 10-day high. So if there is a failure on those, then it stands to reason that could also be a large fail, simply because they've come so far from their 10-day high that a return to the 10-day high is meaningful, but that means they've been losing a lot. And so if it fails further, then stop and reversing on these, or just going short if they're weak, is certainly an opportunity. The RLFF Insights. Now, I should also say that this gives you some automatic trade framing data for mechanical entries, and tells you the 10-day high and so forth, and what the initial risk might reasonably be for swing trading one day at a time. Regression line fractal framework I've described in other areas, but suffice it to say these are screens in their various populations of the Dow 30, the ETF 100, and so forth, where the difference between the estimate of fair value based on very short-term trading and longer-term buy and holding is most dramatic. That the difference in opinions is so great, which in my view creates interesting price tensions between those two different demographics, between the longer term and the shorter term. And it gets expressed in terms of reward to risk as a function of their daily ATR. So this is more like one-day swing trading, which can be chained in the sense that as long as that reward to risk ratio is good to go compared to its peers, that you still have reasons to believe that the differences of opinion make it a reasonable trading opportunity. A similar idea on the daily squeezes. These are ones in which the daily ranges have been large, but the previous day's range was small, and the difference there in volatility creates like a compression, which when you compare it to its maximum daily reasonable range, the range stat, you get some favorable reward to risks when you compare yesterday's range to its range stat. It's really a measure of how coiled is that spring, and then expressed as a reward to risk ratio. And this is something that can go in either direction too. So that's how I use the daily squeeze. Now the market mosaic, these are deeper insights into the market condition that I want to have looking at tomorrow, with my sense of where the market is in terms of location and posture, so that I can be ready for what kind of day it is tomorrow. I look at it, the 30-day regression line. The straight line is up, but it's the the shorter-term polynomial regression line is rolled over, so that means some of that steam has come out of it. It's like an early warning. This compares the slope of the 30-day regression line to its 10-day moving average, and then expresses that statistically compared to the last 180 days, how steep or whatnot it's been. And when it's got a when it crosses its own 10-period moving average like it did here, more than one standard deviation from the black line, then that tells me that this was a potential intermediate term high because that momentum is starting to roll over. And then this is that same chart, only it looks back the entire 180 days. This one compares price to the long-term 200-day moving average, expresses that statistically, so I get a sense, really, I think, more like longer-term momentum. So this is all a case in which both short and long-term guys have started to put the question to the market and are not convinced of that long-term relative strength. There's I think, some realism now about what Trump can actually do, so I expect more weakness rather than less, particularly if they are as bad at managing tax breaks as they were at healthcare, and this is going to get worse in a hurry. Volatility still incredibly low, back to long-term normal conditions in terms of the slope stat, but also in terms of volatility. And now these, I'm going to go through these fairly rapidly. The Intraday Insights are now things where I'm looking for targets that I collected out of Section 2 or even inferred from Section 1, where I'm pulling out deeper insights for constructing trade frames, looking at some of these descriptive statistics for my preferred targets. And so I'm not going to dwell on those right now. These are really just referencing my normal targets. I will say that the S&P volatility over different holding periods. This is just I think, a handy piece of research for you to see just how potentially volatile markets can be. And so this examines over the last 10 years all the one-day moves, finds that the average, not surprisingly, is around zero, and that plus or minus one standard deviation of about 1.4% is what tells you had an extraordinary day or not in terms of a one-day move. And then 5 days, you have to get more than 2.8% or minus 2.4% to really have a significant 5-day move, and so on all the way up. Notice on 40 days that until you get more than plus 8 or minus 5.5, it's still within the bound of a normal 40-day move. The current reading over the last 40 days is 2.49%, so that fits well within the bound of normal for the last 40 days. It only has a z-score of 0.14, for example. Whereas in the last 5 days, the market's down minus 1.27, which gives it a z-score of minus 0.56. So in all of these measures, the z-scores, you'll notice, are less than plus or minus 1. So we have had normal behavior in terms of absolute market moves over the last 1, 5, 10, 20, and 40 days. So it just gives a sense of where we are in the life cycle of trades that have been held for that long, given that kind of a market. So it's been a perfectly normal market in terms of how far it's come in 40 days. The swing z-scores, these are just a handful of my most favored targets. I like to see all of their z-scores from that previous chart just brought into one, and I can see at a glance that emerging markets really have been the best performing in terms of how they've gained compared to their historical norms, and so that's not surprising given some of the other insights we had from the various other lenses we look at. So to me, emerging markets, and by the way, Mexico is one of those. EWW has been one of my favorite intraday and swing targets for a variety of reasons. That's not the only reason. But this reinforces why we should be paying attention to Mexico. The z-scores of these three regression line slopes, looking at the 10, 30, and 90, this is like a smoothed, almost hydraulic sense of the tide. So the red is the 90. You can see we got up to almost plus 2 SD above normal and now have rolled over. The 30 rolled over and has sharply come back towards the zero line, and the 10-day has just been very negative. In that same period of time, when The 10 started to peak. You notice that really the price had come out of the dragon and has now rolled over and come to the bottom of the dragon. Now, what that says is that this is a natural place for the market to find support or for it to crack. Now, in the last 180 days, it only has cracked this one time, which led to a nice this was the election, and then led to this Trump movement. You can see that leg 1, leg 2, leg 3, already the steam coming out of this hot air balloon that is the Trumpinator. So I'm ready for a retest back to 225. Now, this price level cracks, then that's significant. Even a move back to test this, back to 225, would be seen as a confirmation that the Trump mojo is gone. So when you combine that kind of warning built into price action, and the fact that there's still a 10-point move in the S&P to go down and test this, along with that risk Z having rolled over and looking weak, that's why I'm really concerned about and also ready to seize an opportunity for these intraday volatility spikes that'll first manifest in the combination of XIV and VIX. And then I think that looking at non-U.S. sectors that have been the strongest, like emerging markets, now becomes a way to start playing discretionary money flowing away from the U.S., and I see it likely to go into those areas again that are large enough to hold it, like Brazil or the broad indexes that are global. So that's the 3 regression line slope insights. The last one here, this is where I would drill down and look at the specific symbols that I've collected, and I'm looking for insights from these frog lists for daily and weekly. I don't do anything with the monthlies yet, but I'm really looking mostly at where my favorite targets are in terms of their daily frog numbers. And for swing trading, it's possible to use weekly frog boxes as a measure of noise versus signal in swing trades, and I'll cover that more in another video later this week. But that's my read on the markets now, and I spent a little more on the process and these sections than I did on framing particular trades. But what I'll go back through now is taking a look at the symbols I already hold on my swing portfolio and framing them with the regression line crossover and Bollinger Band framework to see where they are and what I need to do to preserve gains or to set them up for continuation patterns. And then I'll be using things like these fail stats, gain stats, gap stats to prepare my daily charts for the magnitudes of moves that we can expect. And then I'll develop some of these ideas into contingency trading plans based on, is the market going up or going down, and who are the leaders and laggards, using our logic chains to quickly find the targets that are most interesting based on price action starting tomorrow. So that's Ken Wong from Tortoise Capital with a review of the weekend trading reports and what I'm calling our weekend market report review routine. So thanks for your kind attention. Keep your risk measured and your powder dry.